So stocks started off the day decent, filled in a little bit of a gap to the downside, but by the end of the day, not so good. We didn't do so well, and we're going to break down what caused the decline, what caused stocks, which stocks fell the most, and why. And this idea of have we started the intermediate pullback or not, and has the Nasdaq started? So we're going to talk about that a little bit. That was a common topic today, especially on Twitter and on TV. So we're going to break down this idea of starting an intermediate pullback and why we're actually getting a really, really good benefit right now in terms of how we're dropping on the S&P and the Russell, for example. So I'm going to break that down in today's video. We're also going to take a look at a stock who's a big bellwether company that's on its own intermediate decline right now and is showing us a good opportunity for a downside trade. So let's go ahead and get started. Today is Wednesday, March the 3rd, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's take a look at the S&P 500 with the Market Forecast Indicator. You can see today's drop and what it looks like here. Light pink shading, yellow line. Again, we're not down that 1.5% below the moving average. Is a key level we look for in terms of whether or not we're starting an intermediate pullback or not. So you see how far far down we're just over 1%, and you can see it's getting to below 1.5% to 2%. That's when we're down enough to not just be one of these light pink shading yellow lines, which end up being pretty bullish. Even the last two have been pretty bullish. So we'll see if this one turns out to be. Again, we're also still between the 0 and 23% retracement level, and we don't have intermediate pullbacks that start there. Now, one thing to keep in mind is like how bullish this was, because the momentum line didn't finish at extreme lows, and of course the near-term line didn't either. You come over here and you had the momentum line down and to an extreme low point, and but you're still up above the moving average, and you come over to this level, light pink shading yellow line again. The momentum line did not get to these extreme lows. This one, however, light pink shading yellow line, we do have an extreme low. So a little bit of little sign that we might not bounce up like we did the last couple of times. Of course, when you look at the Nasdaq, it's even worse. The Nasdaq is in dark pink shading and red line. In fact, I have a tweet from an old colleague of mine over still at TD Ameritrade in their education here. James Boyd mentioning, hey, could the drop on the NDX just be getting started here? And it's like, well, if you all who have been watching the Market Outlook know that it actually started over here, right? When we got the breakdown and then we closed down below the 23% retracement, and all the other signs that we've talked about before last week when that happened, that the Nasdaq had started its pullback. You had an opportunity to if you're still long a lot of Qs, you had an opportunity to reduce how bullish you are on this bounce. And we talked about that on Monday, how we weren't sold on that bounce, even though it got back above the 23% retracement. We weren't sold on that bounce. We expected it would come back. It did yesterday and followed through today, and now closing below all these lows. Yeah, it just isn't getting started. It had already started, right? We just had an opportunity to take advantage of it in the last couple of days, and now we're full tilt here on the Nasdaq, breaking below the 38% retracement level, working its way down towards this longer term, this 23% retracement of this longer term move off that COVID low point. Not the case yet for the Russell. The Russell is just barely getting light pink shading and a yellow line, just barely closing below the moving average. But again, associated with an extremely oversold momentum line, about as oversold as you can get at 0.14. So the intermediate line's falling down, still between 0 and 23% retracement. So we're not breaking down yet, but you can kind of see how, look at the bearish near-term highs we've been getting. A brief near-term rally only lasted a couple of days. On the S&P 500, same thing. The near-term rally did not get up above 80. This one only lasted one day. We only had one day up above 50 before falling back down. And we talked about how at the end of intermediate runs, you start to get more frequent and smaller near-term rallies. In this case, also not getting up above the 80th percentile, and that's what we're getting here. So We might even have another day or two, though it seems like, based on what the Nasdaq's showing us, that we might be started on this exhale. Now, when we do have exhales, we don't go down every day. You can see you go down, you get a good bounce. You go down, you get a good bounce. You go down, you get a good bounce. So it's not down, 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 down every single day. You bounce off of significant down days. You look at the S&P 500 on this chart, and you see, okay, we're still not really getting a significant gap to the downside. We still haven't really had a significant drop. We had 1-2% drop. That's the day that the Qs dropped down, but we rallied right off of that. You can see same thing here. We rallied 3% down, we went 3% up. Now we're 3% down again here. Is that going to translate to more weakness or 3% up? You notice we didn't, again, over here we did get a pretty significant gap, but today we didn't, right? Very, very small gap there. So it seems like, we are and I think I said this in the last video, I might have said it in the class, that one of two things is going to happen. Either the rest of these indexes are going to follow up on the Nasdaq's breakdown, or the Nasdaq is going to bounce back up and get back between 0 and 23 like all the other major indexes, get back above its moving average. I was leaning more towards that the rest of these would follow the Nasdaq's breakdown, and it seems to be that that's the direction that we're going. And the nice thing is, for a lot of you, is it's been going pretty darn slowly. So we have a lot of opportunities to start to get far less bullish. If you're still very aggressively bullish, you have a lot of opportunities to get far less bullish before, the bulk of the selling, like the bigger drop. I mean, I'm not talking about like COVID style fall off a cliff drop. I'm just talking about, the drop down to the 38, maybe down to this orange line. The bulk of that drop that would get us down into this area, will occur rather quickly, and you've had a lot of time to anticipate and prepare for that type of move if we end up actually getting one. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, click that thumbs up icon. That tells us that you liked the video today and that you want us to do another video again tomorrow. Quick way to give us feedback. If you don't like our videos, of course, you don't even have to click on anything. You don't even have to watch. But if you do like our videos and you want to let us know, you can do so with one click. You can do that even right now while you're watching. Also comment, what'd you get out down there? Comment on what you got out of the video today. What stood out to you? What questions or comments do you have? Post those down there. Join our website at marketscholars.com. There's a link popping out right there at the top right corner of your screen. Click on that link to subscribe to our site for free. You get access to our Market Outlook forum on our site, our message board on our site for free. Follow me on Twitter for more content in between the videos from day to day. There's my handle up here at DavidSettle42. And join our Market Outlook Facebook group that we've created. If you're watching us here on our site, scroll down here, check out some of these things on the right. Click on this icon here, or you can also go up under Market Outlook and click on Live Trade Review. I do a live video every day. I do the Market Outlook at 3:30 Eastern Time for our both our Premium and our Plus subscribers. So you get access to that. Also, we have 8 different trading rooms for both our Premium and Plus subscribers. Our Q&A session here that you can see, Brandon's got one coming up. I've got mine on Saturday morning. Those are for our Premium subscribers, and as well as access to our class forums and Premium tools are also available for our Premium subscribers. And incidentally, you actually get access to all that stuff for less per month on average than what you're paying for the Plus subscription. So keep that in mind there. Come down here, click on this heart. It opens up a new tab. Hit that like button. Also come down and hit this thumbs up icon. Again, takes you to another new tab. Hit that like button right there. Again, the more you do that, the more people will see our content that follow us, because all of our followers don't see our content, right? The more likes and engagements it has, the more Twitter and Facebook will promote it. It also benefits you because Twitter and Facebook will promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us here. All right, let's get back to the charts here. Let's take a look at the long term. Remember how we started the weekly chart on Monday with kind of a little bit of a bearish candle. Well, now we're Wednesday and we're still kind of in this transition, little kind of a bearish candle. Still not a full-blown bearish candle. And keep in mind that next week's candle, as of right now, we still got 2 days left, but as of right now, next week's candle will start off at about 38.60. That's the midpoint of this week's body, so 38.60. We're trading at 38.19. So we're going to start off with the bearish candle next week, assuming we hold in this area. Obviously, we have 2 days, so we'll see what ends up happening. The NASDAQ does have the bearish candle. So again, when we talk about, as the NASDAQ started its drop, no, it started its drop last week, right? And we talked about that, and that's the case. And the Russell's a different story. It's still getting the transitions and coming down from an extremely high PPO here. So again, it kind of shows you, how much, like the NASDAQ, once it's done with this little weakness here, then it's going to be done quicker. In fact, it'll be done probably a little bit, after the Russell starts, and then the Russell has a lot more room to come down towards, like, say, it's 38% retracement versus the NASDAQ, which you notice is not very far away from its 38% retracement. So that's why we say, there's a better margin of safety here once this weakness in the NASDAQ is done and it transfers more over to those small cap names. Take a look at the 3 green arrow chart. For the SPY, you got 1.5 times the average volume again. So very strong volume, 119 million shares trading hands. Today's trading range, 5.5 points. If you look at the gap, 386.54, and today's high is 386.83. So we filled in the gap there, 5.5 points. You look at today's trading range and the volume here, then you can see that that's about average for how, but the volume is well up above the average. Look really quickly at the 2 line versions of the MACD and stochastics, and you can see this was significant last week. We stayed down below the 17-day moving average, popped right back above both the 17 and the 8, came right back down below that yesterday, and now we're definitely below the 30 at this point. So the MACD has dropped negative, more negative than it's been in this entire pullback, right? The histogram has rolled back down to the downside, and our stochastics has dropped below the 40th percentile, with the moving average moving towards the 40th percentile pretty rapidly too. So again, you can see the signs that you're already getting on the Qs, right? The Qs, again, you can see these averages have already dropped below. We've been below the 17-day this whole time. We never did pop above the 17-day a couple days ago. The MACD is very negative. So very easily intermediate pullback zone, and you can see one thing I talked about in class today is this Arun indicator. The Arun indicator, one really quickly here, has to do with the 4-week trading range. So this one right here. So what we're about to look at is the Arun indicator looks at where the high tag is in relation to these 20 days and where the low tag is. And you can see the low tag. This is significant for SPY because before, on yesterday, the low tag was way over here on the left. It was on that first day. But after that went off and we have a new day now, then the low tag moved all the way over here. And you can see we're actually threatening to get a new low tag even further to the right. But the low tag is now on the right of the high tag. That had already been the case for the Qs, right? And we got a new low tag again. And it still isn't quite yet the case for IWM. IWM, you can see that, but it will be tomorrow. When we get this off, you'll actually have the low tag again over here for one more day, and then you'll have the low tag right here after that. So it will be on the right. So they kind of that's what the Arun indicator looks at. So if you look at this indicator here, and I've got it for 20 days. So the green line is the high tag, and 100% is the current day. This red line is the low tag, and the 0 level is the first day. So there's 20 days, right, on this chart. So so when you look at this chart from 0 to 100, this is the 0 line, and this is the 100. This day 1 is the 0 line. So if the high tag was there, the high tag would be at 0. If the low tag was on today, the low tag would be at 100, right? So this is the 0 line, this is the 100 line, this is the red line, this is the green line. The high tag is a green line, the low tag is a red line. So if I were to pull back up that Arun, again, the red line is the low tag, the green line is the high tag. So you can see the high tag is further over to the left on that 4-week chart than it has been since the pullback here. But for the first time, the low tag is past it. And that can happen briefly. You can see it happen right there. The low tag flipped over to the right of the high tag there, but it only lasted about a day before we got a new high. And the high hit 100, which means we got a new high that day, a new 4-week high. So you see, when you're bullish, when you're on these bullish intermediate runs, the high tag's up above the low tag. When you're on bearish runs, the low tag is above the high tag, but again, this was about as close to an intermediate pullback as we could get without actually being one. You notice that the low tag did get above the high tag. The green line got above the red line, got above the green line for quite an extended period of time, but never did get up here to the top like it did here. So that's kind of the other thing. The red line's got to get above the green. It's got to stay above the green for more than just a single day, and then it's got to get up to these high levels. Those are all kind of hallmarks of an intermediate pullback. So you can see the S&P is barely today just crossed above the green. And how likely are we going to get the green to pop back up above the red? Not very likely, because we're not likely to get a new high tag anytime soon. If you look at the Qs that the green lines passed through the red lines passed through the green and did hit up to these very high levels, and the green lines falling down to these really low levels. So you notice it doesn't stay down there for very long. The green line can stay up for a very long time, but it doesn't stay down for very long. So intermediate pullbacks don't last nearly as long. You can see, look, it doesn't stay down here for very long. The green line, it can't, like in this COVID area, we stayed down for a little bit of time, but even that wasn't very long compared to some of these intermediate runs that we've had. Like very, very short periods of time where the green line is down at these low levels. And in fact, a lot of times when the green line gets down to these low levels and we have already bounced, see, like there, by the time we got to that one, we had already bounced. By the time we got here, we had already bounced, right? By the time you got to this one here, we had already bounced off of that low point. By the time we got to this one, we had already bounced. So these intermediate pullbacks don't last long enough for us to get an extended period of time. Even by the time it got down here, you notice we had started to bounce. When you get those extreme lows, in fact, a lot of times, by the time you get to like the lowest point, the green line was down there, down at these lows. By the time you got to this lowest point, the green line was just barely crossing below that 70 level. By the time you got to that lowest point, the green line was barely crossing below that 70 level. By the time you got over here, see on this one here, by the time you got to that really significant low point, the green line was still above it. By the time you got to this one, we were still up above 30. So it kind of gives you an idea that when you get these big drops, it doesn't, we don't stay down for very long, but the green line can stay up for very long. So when it gets back up to the top, that's a good sign and suggests that we can be bullish for a while, right? A new intermediate run is starting. But that's not what we're getting. And as I showed you before on the NASDAQ, the red line is easily above there. And the Russell still got some room to go. You notice its green line is way down. So the high tag is really moved over to the left on that chart, but the red line is still way down there. So we're still not, it hasn't popped up. But like I said, it won't do it tomorrow either. But the day after, that red line is going to pop way up to the upside. It's going to pop way above the green line. Then it's just going to be a matter of when we get our next high tag. And it doesn't look like we'll get a new high tag anytime soon here either. And the low is going to move all the way over here. And by then we might be threatening with a new low point. If we were to break through these lows, there's not a whole lot of volume down below there for IWM. So it's going to be very easy for it to move. You can see how we filled in all these gaps. We filled in that gap from just a couple days ago. And a lot of people thought that we were back to being bullish again, right? And if you watched this video, you knew that we weren't. And that eventually we'd fill in that gap, and lo and behold, we have. Let's take a look at the volatility index. Still not quite showing a significant jump in volatility. We're still not there yet on SPY, and VXN is a different story. We don't have the same, we don't have a 3-month VXN down there, but you can see how we're getting back up to the 30s on the NASDAQ 100's volatility. So we are starting to get more and more bearish, and we'll see. We've been forming higher lows, and now my expectation is that we'll form a higher high. The question is how high? More than likely up to about 105%, and that's about it. But we'll see if that ends up being the case, and how likely, whether we even get that by the end of the week or not. If we follow up today's weakness, most likely we'll probably follow up today's weakness with a little bit of a bounce to the upside. That tends to happen when you get these big moves down, you follow by big moves up. Even here we had a couple there, you had some upward move in between. So, but if we get this kind of drop here, that's what started the intermediate pullback, when you didn't get a bounce back up. It took 3 days before you had a rally, and then we came right back down. So that kind of cluster of weakness, you're kind of seeing that here, suggests again that an intermediate pullback is beginning versus all these other one-time drops that are followed by similar size moves to the upside. All right, so to summarize the technical outlook, this pullback has already already started in the NASDAQ. We've talked about that before. We talked about the potential and likelihood that that would bleed over into the other indexes, and you're starting to see more and more signs. The nice thing is that it's doing it very slowly, so it's not like it just came out of nowhere and we were exhaling here and there's nothing we can do about it. There's been a nice, steady, kind of gradual move to produce these signs of pullback that you have an opportunity to de-risk, so to speak, without not being bullish, right? Because we could bounce right back up tomorrow and still be bullish for who knows how long, right? Because not everything is perfect, nothing's 100% in technical analysis. But if it turns out to be the more likely scenario, and what I'm expecting, that we tend to be, show some weakness here between, breaking the 23% retracement for a while and staying down below it for a while, for, a month to 2 months or something like that. That's a more likely scenario. Then we can prepare for that already because of how we're kind of grinding lower here, which is kind of rare to do that. And with the clear signs that we're seeing in the NASDAQ that can suggest what is to come in some of these other areas. So what do you think? Do you agree with that or do you disagree? Let me know in the comment section down below, especially if you disagree. What charts or indicators you're looking at that suggests maybe you're a lot more bullish than I am right now, or you look out below, right? You're a lot more bearish than I am. Post those in the comment section. All right, now let's take a look at how what drove the price action today, and you can see if I just look at this 1 day. So let's come over here to today only, so March the 3rd. You can see that we started off with small caps doing very well. The stocks went up to the new highs. Small caps are up over 1%. S&P was almost break even. The NASDAQ, which had fallen the most, which is pretty rare to see the Qs and bonds and gold all down about the same amount early in the morning when small caps were bullish and commodities were bullish and emerging markets were bullish and everything else was bullish. The dollar in this case too. But obviously you can see that didn't last very long. After we rallied, the Qs rallied. We're still only down about 0.75%. Small caps are up 1%. After that, you can see, okay, that we dropped down to the lows of the session at 3% down. But look how bonds and gold were still down as you have this kind of this commodity boom still, but the dollar. So the commodity booms pushes yields. Inflation expectations pushes yields higher, but the dollar's strength is pushing gold down, and so you see that showing up in some of its charts. If you look at the dollar relative to the euro, you can see how we are continuing. We had that long upper shadow at the 23% retracement. We rolled over. We're breaking back down now below the 38% retracement level. The near-term line's looking like it's going to produce or potentially produce a bearish near-term high point, and we'll roll back down. The intermediate line falling back down. Market sentiment line's falling down too. Path of least resistance to the downside. I still think we have an opportunity to go at least down to this 62% retracement level, if not all the way down to this 38% retracement of the longer term euro rally that started way over here last May. Also happened to be about the time that if you look at the comparison chart here, about the time that yields started to rise, right? Everyone's been making this big fuss on how yields have been moving. If I pull this up here, there we go. You can see yields started to rally really about August. They took off. So they took off. The dollar's actually dropped here And then yields kind of went sideways for a while the dollar fell. And then now, as the dollar is rallying, yields are rallying. Yields are pushing up higher. So kind of an interesting pattern developing here, that you're getting your biggest move on yields when the euro is done with its rally. So that suggests, okay, well, when the yields are done making their return, then that's going to push the dollar back down. And right now, I showed you this chart before, but yields have just insanely high, especially with the 1 year. Oh, this is actually the quarterly. This is a quarterly return for yields, up 75%. Big, fast move higher that you can see has gone parabolic here. You can also see that on the DMI, how the move here on the yields has just gone parabolic here at the end. Look how high its ADX is, how low the negative index. We're above 50 in the positive. So at some point in time, this parabolic move is going to end. Not that the trend is going to change, but you're going to get some kind of pullback here, which means that TLT, which is the opposite, right? Has had this parabolic move in to the downside with this strong move to the upside and the negative index above 50, the far below 10 on the positive index. That's a pretty strong move. That's probably the low point there, especially with a little bit of a lower shadow. So we'll see if bonds start to make their way back above the 23% and up towards 150, if not eventually up towards, if you look at the Bollinger Bandwidth, where bonds would go in the case of an exhale, right? An exhale and risk appetite, probably up to this 38% retracement where you start to get some volume, if not eventually up to that 50% or 62% retracement level, up towards back up towards where the value area is. And that value area is going to shift a little bit, probably pick that up in the next few weeks as we clear off the big spike, this big COVID move, and we get more steady with the volume up in this direction. All right, so when you take a look at the sector rotation, you can see here same idea. Let's look at just today and how it performed here just today alone. And you can see we started off strong with financials and energy up, and at the highs of the day here for the S&P, financials and energy were up, industrials were doing really well, communication services have bounced up, utilities were down the worst, and then by the end of the day, discretionary, technology, communication services all down the most. And you can see energy and financials and industrials down off their highs, but still positive for the day. So you can see where materials were positive for the day last, before they fell back down towards at the end, again pressured by gold in those particular, some of those gold stocks in there. But again, you can see how we really haven't flipped the script yet on this ratio chart, moving back up, right? And so as long as we keep going down, the NASDAQ is where most of the weakness is going to be on this chart to the downside. So I mentioned to you before the relative strength chart of the major sector, the S&P sectors, you can see, and I had a market scholar, Clarence, send me an email talking about, and Brandon actually covered this too in a tweet. If you follow Brandon on Twitter, that some of these sector are different when you look at the small cap stocks within these areas. These are all large. These are all S&P 500, but you can look at the small cap areas and see how discretionary actually is giving you a little bit of strength, but from a daily standpoint, we're still getting more momentum and more relative strength in these four areas: energy, financials, industrials, materials, than we are in these cyclical areas down here: discretionary, technology, and communication services moving down to the left. Utilities is moving up, healthcare is moving up, staples has got some positive momentum. So as this rotates down to the, starts to rotate down to the left, and these safe haven areas rotate up to the right, then that's when we'll know from a rotation standpoint that we're heading into more of an extended decline. You can see here when we got to this point, you can see the safe haven areas, utilities, real estate, healthcare, staples, all moving up to the right during this period of weakness once we started the intermediate decline back in September and October. Let's take a quick look at the 12 grid, and you can also see too where the weakness is showing up here in this 12 grid chart. We're getting light pink shade or dark pink shading and a yellow line in the XLK well below the moving average. So very indicative of a pullback that we already are getting in XLY, dark pink shading and a red line. XLC is not quite there yet, but you can look at real estate, look at utilities, very interest rate sensitive. I would say utilities probably overextended to the downside, which means you can't really start pullbacks until your safety trades are oversold, right? That we're focused more on the risk trades than the safety trades, and so it looks like we're getting pretty oversold on XLU and XLP as well, having been down, dark pink shading in a red line for a while, and you can see healthcare. So some weakness in these areas, oversold levels in these areas suggest we may now have the ability to bounce up off of these and show some relative strength in these areas, especially relative to the very strong levels we're still at in industrials and financials and energy, and to a lesser degree materials here in the middle row. All right, so that brings us to our trade idea of the day, and let's take a look at Apple. Apple's a stock we've been trading in our class portfolio and with another trade, but you can see it's obviously we've been in the bearish pattern, dark pink shading and a red line, but you can see here that it made an attempt, like everything else, in the last couple of days to get back going again. It had broken its 23% retracement level. It made it, just like the NASDAQ, got back up above it, flirted with the 17-day moving average, but just like that, we're back below the 8-day. The histogram's rolling back down. Stochastics is below 30. You look at all these other oscillators. CCI is below, excuse me, it's SPX. CCI is down below the 0 level, easily getting below 200 on that decline. The RSI got down back below 40 now. It had hit below 30. I mean, there's some pretty strong bearish sentiment going on right now. You can see that we are below -3 or about -3.5. So moderately strong trend that we're almost up to 80 on here. So we're to the bottom end of the cloud. It's pretty bearish. The only difference is we don't have as much downside to go because there's a pretty strong point of control support at 115. You could probably go all the way down to maybe 110, where that 38% retracement is of this rally, where there's going to be some pretty significant support between 110 and 115. What's the one more? The directional movement index here. You can see the ADX is rising above 25. So we got, we've got a good strong trend going here. We're established to the downside. So to take advantage then of the downside move, but not necessarily too directional of a trade, we decided to do a bear call spread where we sell the 127.5, buy the 130. This is what it looks like on. Get rid of the other trade that we have, the Iron Condor, and let's get rid of that trade there, and then here's our April's. So this is what it looks like. You can see the break evens at 128 or 128.35. Let me show you where that ends up looking like here on the chart on the 4-week range. 128.35. You can see basically we broke down the midpoint of this 4-week range. You can see the low tag is over here. The high tag's on the left. They're kind of thinking about that Arun indicator again. We're not going to get a high tag anytime soon, but we can get a low tag pretty soon. So that's going to keep when you're looking at this has been something we've been talking about today. If I can get to it, here we go. Apple. The negative has gotten up here. It's above the positive. The high tag is down low. It's going to be down there for a while. The low tag we can get right back up to 100 pretty easy. So we'll kind of keep our eyes just reflective of how bearish it is. So for us to get out of this trade, essentially we would have to let's see right here. Essentially we'd have to break back up, reverse this 2-day decline, and get back above the chart's midpoint, get through the point of get through the volume nodes here in the lower end of the value area, get into the value area, get through the lower end, and then break back up now towards the resistance. So that's the kind of, you have to really kind of change directions, and if that's the case, then we'll take we'll shoot for. I did a full position size on here, so we're shooting for $510 as a result of that. So we're getting pretty good premium. So I'm willing to lose out of the 990. I'm willing to lose $510. So we'll take that loss if we end up getting to that point. All right, so that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. You post any new thread there, reply to anybody else's thread with any questions or comments you have. Let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, like us on Facebook and Twitter as well, and comment on the video. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.